What happens in the trade is second most important to what happens before the trade starts. And that's knowing how much to risk per trade is the only thing that separates real day traders from those who are gamblers. Now in this video, we'll talk about different ways to assess and adjust how much risk you're taking. And then we'll look at the most important indicator in all of trading and how that can help you assess how much to risk per trade. Now, who am I? My name is Evan Scales, and I've been trading now for about 7.5 years. And just this week alone, I'm recording this July 31st, 2025. I helped over 9 traders earn funded accounts to a total of $545,000 in just 4 days. And the way I do that is what's called a past perfect strategy. That's not the point of this video, but what it does rely on is knowing how much to risk per trade and understanding the probabilities of you having success versus failure. So I know a little bit about what I'm talking about. Okay, no more intro needed. Let's get right into it. How much to risk? The very first thing you have to consider is the time of day. I know this sounds obvious, but sometimes I think we skip over this, which is trading pre-market versus during market hours versus, and I'm talking about market hours as a New York session versus after market close and like overnight and Asian session. That plays a big deal on how much you should be risking. I personally don't believe you should be trying to scalp during these times because the spreads are really high. So you might see a spread as large as 1.5 points on NQ as an example. Well, that's 20 bucks and then another $10 on top of that, and then $3 on each side that you have to pay in commission. So you need the price to move 2 full points for you to break even on a trade. That's insane. And so when you're thinking about how much to risk, time of day is a humongous factor in this. The next thing is the asset. This kind of plays between time of day because certain assets move better, smoother, and they're a lot more liquid at different times. Now, I'm in the US, most of you guys are in the US, so most assets will be liquid pretty much all day, but specifically during New York session. However, I know gold moves very well in the evenings. I know that crude oil moves very well pre-market. And so depending on the asset that you're trading and what time of day you're trading said asset, that could determine how much you should be risking per transaction. The last thing, or not the last thing, but the next thing we have to consider is the account size. We can't trade every single account the exact same way. That doesn't make any sense. If you've got a 25K, like I love a 25K Apex account. It's just my weakness. I love it. I can't trade the same amount of contracts I would trade a 100K account or even a 50K account because it's smaller. My drawdown is my leash is way shorter. Can't trade the same way. If I have a 100K eval, I'm going to trade that differently than a 100K funded account, right? So not only the account size, but the account type is hugely important. Risk up versus risk down. I'm always going to be way more risk off with funded accounts rather than evals. I'm going to be pretty much risk on. Now, the last thing we're going to look at is the actual indicator that helps me determine how much I should be risking per trade. We're going to look at this. I'm going to show you how to adjust it and how to actually use it. So let's go to our NQ chart here. We're going to go to indicators. And if you've ever heard me speak about anything, you know this one already. The ATR, the average true range. All right, let's go ahead and add that to the chart. Make sure my face isn't in the way. All right. Now, once that's on your chart, it's going to be below the screen. I like to edit it. So let me raise this up so you guys can see what I'm doing. I go to settings. I make the length 7. This just makes it a little bit more recent. So we're measuring the previous 7 candles instead of 14. And then the smoothing, I just go to EMA. And then you can leave everything else the exact same. We can make the color something a little bit easier to see. We'll go yellow, we'll make it thick. All right, good. The ATR is the greatest indicator for any sort of trading. What it tells you is the average size of the most recent, in this case, 7 candles. So how much movement is occurring on this 1 minute NQ chart in the previous 7 candles. This would tell me that we're looking at about 8 points. So if I know that we're getting about 8 points of movement, that will help me decide like how much risk I should be taking. To me, 8 points is about 1 NQ contract if we're trading an eval or even a funded account, right? Now we had a humongous spike right here where the ATR jumped up because this candle was so big to 57. Well, we had this, it was October and November kind of 2024 before the election, after the election, right after, I guess, where the ATR, we'd log in and it would be at like 35, 40, 50. It'd even be in the 60s at times on the 1 minute chart. We'd have 1 minute candles that were larger than our computer screens. And so if I looked at the ATR and said, oh my Lord, I can't believe how large these candles are, I would jump to micros. That would be what I do. If you've ever gotten to a trade and you're like, holy shit, I am down way more than I ever thought I was or would be. That's because you don't know how large the candles are. You can't just look at candles and determine, I know what size they are. You need a tool. Now, you could go and just measure how big they are. You could do that. But that's a lot of work. right? And you can just have a tool do it for you, which is what the ATR is. So it allows you to streamline the process of looking at how much to risk and understanding what's going on. Now, you can also use the ATR as a stop loss if you wanted to. You'd be a little cute with it. So you would look at the ATR and let's just use this region over here. This candle at this time was at 22. So we scroll over, see 22. Okay, so then if I'm gonna go short, or let's say I'm gonna go short. Well, I need to make sure that my stop loss is at least 22 points. This is 33 points, 22 points, and then we keep an even 1-to-1, I guess. And we would have hit a take profit, which is pretty nice, right? So really good trade there. But the ATR essentially just helps us see the absolute size, and we can try to get rid of some of these candles. This was if you guys are curious, I'm curious how large this candle was. That is 158 points. That's insane. Okay. Now, if you've ever gotten to a trade and you're like, man, I really thought that price would be moving faster than this, or why is this candle like humongous on my screen, but like my P&L isn't all that big? It's because the ATR, or the average range of these candles, is really, really low. And so this is something that you don't have to keep on your screen at all times. I usually keep it tucked underneath. I'll double clicking and pull it up. But if I'm looking at taking a trade, I'm wondering, like, how much should I be risking right now? I'm going to look at the ATR first. That determines what type of asset I'm trading. So if it's NQ or MNQ, I haven't traded MNQ in a long time, but if the ATR were to pick up, or if, for instance, I was trading in my funded account and I saw the ATR was sitting in this like mid 20s to 30s, this could be where I go down to 5 micros. Who knows? I'm definitely not going to trade one NQ contract and try and get a direction right. Even the smallest of movement against me would blow up any account that I have with a 40-point ATR. That's insane, right? 10% of that candle is humongous P&L. So we don't necessarily want that. So you can also use this to look at like good times and bad times to trade throughout the day. Okay, if I zoom way out, you can probably figure out what this huge little pump is right here. And you can figure out what this pump is right here. This is the close, and then this is the open. And then you can look at, okay, like when should I be trading? Time of day. We talked about this before, but okay, here, this is 11 o'clock Central Time, 12 o'clock, 12:30 Eastern Time. So volume really hit a little rut in this region. Depending on how you trade, that might be a good thing, right? The ATR was sitting at like 7 and got as low as 6 and some change, peaked up at around 11. This is still a pretty good movement. And if you have a strategy that's a reversal strategy or like a low volatility strategy, looking at the ATR and trying to map out exactly where to trade, this will help you out tremendously. It's hard to tell, even if price is flat or not moving anywhere, how big these candles are, right? It's very hard to do. You can kind of use your eyes, but you can look at with definitive proof that, okay, this is a much lower region. This region in here, let's get our little rectangle tool. This region in here is way better to trade. This little hour and 10 minutes is much better to trade than the open or than like the early morning session. Okay, once volume begins to really slow down, that might be where I want to trade. Or if you're like, hey, I want to trade where there's high volatility, well, you can do that too. Here's yesterday's close, here's yesterday's open. There was some news that happened right in here. This was Fed day, and so you can see the ATR got its way up to 39. You can see exactly where price is popping. And so if you're like, when should I be trading? What should I be trading? All you have to do is bounce over to different assets. So we're on NQ since we're here. Let's go to gold really quick, GC. All right. And we can take a look at what's going on here. At the close, gold really didn't move all that much. Okay, so I'm looking at this. I've got not even a point of movement right here. So not a whole lot happened. At the open, it was a little bit more aggressive at 2 points of movement. Let's look at crude oil. Actually, let's go back before we move on. Here's like the early morning of gold, which the movement was way higher and better than the second half of the day during market hours, during the New York session. Something to keep your eye on. Here's overnight. This is about the same volume. There's a little pop-up right here at almost 2 points. This is almost the same as the open, which is nuts. So gold moves decently in the evening. So if you're like, hey, I want to trade at night, that's when I can trade the best. Well, if trying to find a strategy or putting together a couple strategies for gold could be beneficial for you because it moves with as much volume as it typically would have. You'll have some news here that would impact gold. So this is during market hours, of course. But on average, in the evenings, it moves the same, if not a little bit more, than during market hours. So if you have a schedule that's a little wonky, gold could be for you. Let's look at crude oil. We'll go here. This will be our last one. Here is a little spike pre-market. Here's the market hours. And here's kind of market timing. So It moves a little bit during market day, which is pretty good. Not very much at night, not at all, it feels like. And then it really picks up. If somebody's like, hey, I really can't trade during market hours, but I'm available like in the early mornings, crude oil is a great thing to trade. It moves a ton pre-market. It's one of the things that like kind of is a leading indicator of the economy actually. So if crude oil, as an example, this is just FYI, but if it's below $60 a barrel, not good, right? Not good for the economy. That we don't want to see that. Now, if it's above $100 a barrel, also not very good. All right, so crude needs to be above 60, and typically like below 85, below 80 is a good spot for oil. Anything above or below those levels can get a little weird, and we don't want to see that. But crude does move very well in the early mornings, and so there are some nice things that you can trade. Now, here's the thing. The ATR tracks and looks at things differently. So if you're on a 1 minute chart, let's go back to NQ really quick. If you're on a 1 minute chart, you're going to see these numbers a certain way. If you go to a 5 minute chart, guess what? The ATR gets larger because the candles themselves are larger. They're not 5 times the size potentially, but they are quite big. And so if I'm going to be trading a higher time frame, I best understand how much movement I'm getting. Now, how much movement per candle you get is not as important on a higher time frame. It's more about knowing how much to risk. So if I was going, like I said here before, if I'm trading NQ and the ATR is at 42, I'm going to jump down to micros because I really don't want to be in a scalp where the thing moves against me really fast. I get blown out of my trade or my account, and then it takes off. Like that would suck, right? That's happened to me many times. You guys have seen me do that live. It's going to happen to you. If it hasn't happened to you, it will, and it's probably already happened to you. So you understand that pain of being over leveraged on a trade. Looking at the ATR can help gauge exactly how much you should be risking. So if I was on a 1 minute chart seeing an ATR at 43, I'm going to go down to like 3 micros and I'll let that trade play out. And if it moves decently enough, I'm going to make good money. Like I'll make some solid coin on that trade. Higher time frame, larger ATR. Daily chart, right? The highest ATR of them all. And this was in just an insane period of time in April where the market was just whipsawing. This is crazy. 1,500 points in a day is unreal. This was a fun time to trade. But for the most part, we can see on the daily chart, like what are relatively speaking, like where price takes off. I was talking to you guys about the ATR being super high. This in December was crazy. And then November was a little wild. And then this is last August as well. So crazy, crazy movements. This right here in March was just nuts too. So you can kind of take a look at, okay, during the summer hours, it kind of makes sense that price is a little slower. We've seen that before, and it's kind of curling up now, so on and so forth. But this is the ATR. This is what it's used for. You look at this before you take a trade, and then you adjust everything you're doing based on what it's giving you. The more points, the less risk. The less amount of points this is showing you, the more risk you can offer. I hope this training helps you and it saves you some money and some time and some cash and some heartache by knowing how much to risk per trade. I'll see you in the next one. Peace.